Hello, everybody. Kirk Spana with today's cooking tips, how to make a good gumbo. First, you start with a cup of flour, and I've been using avocado oil for about the first half an hour of stirring the roux. Very important that you don't add the olive oil until you want to start browning it. So just keep that in mind. And when you're stirring, you'll tend to get some splashes on your black sweatshirt, and then you have to wipe them off here with some water before you go on air. And hopefully, they don't show up on the video. All right. In all seriousness, my gumbo is very good, and the beta testing on it, the focus group testing, they didn't like the name. I called it Kirky Gumbo. They were like, nah, that ain't gonna fly. So I'm actually calling it Kirkalaya, and it's not really Kirkalaya because there's no rice. So if you put it over some rice, I guess maybe, but it's really a gumbo, and just the name didn't work out. So anyway, if you get a chance to relax, the market's not going to eat you, then you will need to relax, do some meditation, do some yoga. It's going to be 70 degrees in Milwaukee today, or just about 70 degrees. So I'm going to go for a walk. And I can tell you that with what I'm seeing in chat rooms and on X, and every now and then I listen in on Twitter still, or Discord still, just everybody's all over the place. So all these people who haven't been listening to guys like me and women like me who have been saying, look, and when I say like me, I mean up here, the idea that the market was going to have a correction this year, all these bulls, no, 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 Trump good, Trump good. It has nothing to do with it. Look, Elon Musk, Donald Trump, Scott Bessent, they have all told you, every single one of them, paying on the front end, transition, need to get the 10-year interest rate down on U.S. Treasuries. So, look, they have told you there would be a correction. So I have been telling you since October to lighten up on all the S&P 500 stocks because they were the ones that are going to get hit the most, because those are the ones that get the most money from the inflows when the economy is good and we're at full employment. So as unemployment ticks up just a little bit, I don't think it's going to get to 5%, but it might. Went up 0.1% last month, and it'll probably go up another 0.1% this month. You're going to see liquidity continue to tighten. And I've seen one article. I've seen, I get so excited. My half caffeinated coffee from Nespresso. I'm gonna get an endorsement deal eventually. Look, I forget where I was going with that. The idea that we wouldn't get a correction because of the rhetoric and the ideology that was out there just was always nonsensical. I've been telling you to sell the S&P 500 stocks because those are the ones that would get hit the most. The IWM stocks, Russell 2000 stocks, they get hit whenever they feel like getting hit, right? So with way over half of all the money going into the S&P 500 stocks, it's actually like 90%. You just have to say, look, we have to be careful here with liquidity tightening up. And then the one thing, and this is where I was going a second ago, that people just aren't factoring in. And I understand that people are superficial in their analysis. I get it. It's why I have a job, because I go 2 or 3 layers deep. I try to get 4 layers deep, but ultimately you don't really need to if you just follow the money. Well, you can follow the foreign direct investment right out the door. So sophisticated international investors have been pulling money out of the U.S. markets now for a few months. That was some of the money at the margin that really pushed it up the last couple of years. There was high confidence in the Biden administration to keep playing by the international rules, which we basically set. So when you say international rules or globalists rules or whatever. They were American rules. Everybody was, yeah, let's keep playing. Well, I understand some of President Trump's complaints. I get it. I understand that Doge is doing a couple of good things while they break other things. The reality is that they're probably going to have to really dramatically cut tariffs from what they start with at some point, and I think that they will. If you take a look at fundamental trends, if you're a rare investor, Shooter did an article that he used the AI, and I mean, I don't know that this is hugely prescient, but the AI that he uses called Sentinel, that he has created a sandbox for, is very good at aggregating the information that's on the web. And there is an idea that Trump will roll back tariffs sometime in Q2 or Q3, maybe even Q4, but after he gets through his negotiation process with everybody. And we don't really have a great time frame on that, because NAFTA, or whatever the heck it's called now, I'm going to call it NAFTA because that's easier, needs to be renegotiated by next year. So I think you're going to see some of the tariffs rolled back. And ultimately, Scott Bessent is telling you, look, part of this is to put pressure on other countries to lower their tariffs. In the end, there's really only three outcomes here. We end up in about the same place, which is probably the most likely scenario. Or there's a trade war, which is probably second. And then third, global tariffs actually come down. If global tariffs come down because of the break it and max pressure campaign that they have, and again, this is another good poker analogy. This is somebody who's playing a very extreme, aggressive, reckless form of poker, with the idea that they're going to try to spin up their chips. And a lot of times those guys win because people fold, right? They get fold equity and they hit a couple of hands. I don't, but they bust out in the long run. So that's the problem we have here. They have to spin up their chips early and then back off, right? And then become tighter to the vest and not just keep rolling the dice or jamming the pot. So we'll see how it works out. But the AI here is kind of laid out a scenario that, hey, he's going to have to back off again. I don't think that's terribly original, but the reality is that I don't know that it really is getting talked about a lot, other than from the people who are the deeper thinkers, because a lot of people are just too superficial. There's just the questions I scold and I'm kind of making fun, but some of the questions that people ask are so short-term in nature and so just like the wrapping paper of what's in the box that I get tired of answering them. I do. And so I make fun of it, but you need to go 2 or 3 levels down on almost everything. And when you finally get to whatever level it is that gets you to the answer of where's the big money going, then you have your answer in almost every single situation. Grandpa said, Kirk, if you want to know how things work, follow the money. Yeah, that was one of the 2 best pieces of advice he ever gave me. That, and if you want to get rich, lay down in front of the baby boomers, they'll make you rich. Well, I've done that, and now I've adapted it to the millennials, right? The millennials are the people making the big money at this point, or about to be making the big money at this point. So if you're not paying attention to the millennials, if you're not understanding they're the largest generation, they are just coming into their peak earning years, like the very front end as the last boomers retire, then you're not paying attention. You're not following the money. People will invest the way they invest, and the big group of people is the millennials. So you need to pay attention to what they are doing. And one of the headlines that I just pulled today was this one. right? And I've been talking about this for a long time, that I thought we are basically on the peak oil plateau now. Basically, supply and demand are roughly in balance. And then around 2030, when probably we have a financial crisis, if we don't have it before then you're going to start to see oil demand fall. And when oil demand falls, that means it'll produce less oil. And I think if the cars that are coming are as good as I think, as far as efficiency and mileage improvements, right? They're not going to improve by 5 miles a gallon. You're going to see average fleet mileage somewhere between double and triple over the next decade. And that is just monumental for oil demand. So if oil demand is going down and we have enough oil to fill demand pretty easily, as demand falls, that means the price will probably fall too. So if price of oil falls, right, the market adjusts. And since over half of all natural gas production is affiliated to oil, natural gas price probably goes up. So you can have a situation where the price of oil is going down because of the change in that demand supply equation, while the price of gas goes up because natural gas demand is going to stay up while affiliated natural gas supply comes down with oil. So what does that mean? That means that we need a lot more alternative energy, because they're just not going to be able to find as much natural gas as they want at a cheap price. So the price of natural gas goes up. That makes solar and batteries and everything else that is alt energy a lot more affordable in a relative scheme. And this guy here at Carlisle, he's a big deal, right? He's a big deal. And he's saying what I've been saying. So we need, as investors, to really focus on the clean energy stocks. And we have several. And we also have a few funds. So keep that in mind. I think that this might be, well, I won't say the biggest. Let's just say I have very high confidence that the clean energy trade will be one of the 3 best trades of the next decade. And when you can have super high confidence that something will be a top 3 trade, you probably should have quite a bit of it. All right, so let's take a look at a few other things here. Shooter also put up that the AI is saying that there's a major potential market catalyst to the downside. You've heard me, and he actually, so Shooter actually listens to me sometimes. That's cool. I mean, honestly, Shooter is just a savant. He's just so smart that, and he's the defensive lineman, right? That end that they say his motor is always running. Oh my gosh, I try to have my motor running as well as Shooter's, but he quoted basically. I always say you're gonna wake up with a limit down events, right? And it's coming, and I don't say it nonstop like the perma bears. I pick my spots. Last 2 years, I said up, 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 and now I'm telling you down, down, down. And I don't know how fast it's going to be. The speed of what can happen is really variable. If you take a look at the financial crisis, it was 9 times. It just kept flowing down like waterfalls, and that's what it looked like on a chart. There are other times when it's an elevator drop. I tend to think we get an elevator drop at some point. And on X, somebody asked me, how fast do I think it'll get to 550 on SPY? I say, I don't know how fast, but I think that low to middle 500s on SPY is pretty much a given. We're almost there. And lower to middle 400s on SPY is about an equal percentage chance. And then the Armageddon zombie apocalypse, or the Jeremy Grantham zone of lower to middle 300s on SPY, is not negligible, right? I don't think it's a high probability, maybe 10 to 20%, but it's not negligible, right? You can't say it's, so out there that I can't put a percentage on it. I'd say 10 to 20% that we see the stock market drop 40, 50% from the top. It's possible. It's not something that hasn't happened. And when you take a look in the mounds in the chart since 2020, you go, we could give a lot of that back. So I don't know how fast things move. Today seems to be a pretty rough day. And I think that you need to be aware that it's probably too late to play too much defense. If you haven't been listening for the last 4 or 5 months, if this is what it took you to get to the point of, well, maybe I should trim some risk, man, you should listen sooner. So I don't know that there's a whole lot you can do to trim risk. I mean, if you're going to be now, and here's why. Because if you hadn't made the move yet to get defensive, then how fast are you going to get offensive when the time comes? Because that might be 6 or 7 weeks from now, right? Weeks. So you need to really think through, should I bother making these tactical moves or not, given that I've already missed quite a bit of it? I don't know. You have to decide, are you going to change the way that you trade? You can't just panic sell now and then be frozen and not buy back until we're higher than this level, right? I mean, you have to at least create some gap. So mechanically speaking, if you're going to do big trimming this week on whichever day ends up being up, then set limit orders to buy stuff back 5 or 10% lower, right? At least incrementally get back in on a mechanical basis so that you're not subject to your own emotions and recency bias. All right. Where else? People have been asking me about the very short lists. Yeah, I'm not going to show all the pages here, but here is the Dow Jones Industrial Average and Mega Cap page. And every now and then I re-rank it by market cap. And I want to just point to this column, the potential gain percentage. So I have a 5-year price potential on all these stocks, and I've been adding them for dividend and growth, and I'll get to the biotechs eventually, but that's really just an exercise in gambling. When you take a look at the potential gain over the next 5 years, and these 5-year price potentials, right, these 5-year ranges are typically towards the high end of what analysts are saying. And then I use about 15 different models for modeling out share price based on different factors like EBITDA and free cash flow yield and things like that. So we take a look at, okay, this is about what the business should look like in the next 5 years if they execute well, things like that. And then I take the range of what the analysts have, and I look at the high end and the low end, and I decide, well, do I think the low end is more likely or the high end is more likely? And then I use my models to see, okay, is my subjective view supported by the data? And then I end up near the high end or the low end of the analyst range. And sometimes I'm in the middle. But these price ranges, these price targets here are pretty close. I mean, they should approximate about where a stock can go. And when you start seeing that almost nothing has, well, actually nothing has the ability to double in the next 5 years from current prices, you should really ask yourself, should I be in mega cap stocks, right? Should I be in these stocks right this minute? Until these numbers, and this gets highlighted when it gets over 50, until a bunch of these numbers are 100-ish percent, it's probably not great to buy the mega caps, but they're getting there. See, as they correct, these are going up. So as a bunch of these start to hit around 100%, that means the group is getting, more price favorable, right? They're starting to price in a margin of safety. And when the mega caps and the Dow Jones stocks look like they could maybe double in the next 5 years, that's 15% a year. Then you think, okay, maybe there's something to take a look at. Now, some of these stocks I think are fully valued right now. Right? I don't even know who this is. McDonald's. I don't think McDonald's has any upside. I don't know that IBM has any upside after their rally. T-Mobile, I think, is fully valued. What's this one? Abbott. Abbott, I don't think has a lot of upside. take a look at these. 3M and Travelers should not be on the Dow Jones Industrial Average anymore. They should get replaced, but we'll see when they get around to that. All right, I'll take a shortcut, look at my portfolio. No, that was enough. I want to talk about Elon Musk fatigue stocks. Now, I have a very complex view of Elon Musk, and I'm very uncertain of what I have right and wrong on him. I really do. It's hard to figure him out. So you take a look at the guy and you say, okay, here's what I know. He's really pissed off a lot of people. I mean, a lot of people. And there is going to be Elon Musk fatigue around the world. And while you have a small new batch of Tesla buyers, you've got whole countries saying we're never buying a Tesla again, right? I mean, they're just getting shut out of the European market. What was it? What were their sales down in Europe? I mean, it was a huge number. It was like less than half. So they have no growth in Europe. I don't think that's coming back anytime soon. They have no growth in China. I don't think that's going to improve much. And I don't think they're going to get much out of India, even though that's what some of the India opening up, chest thumpers got going on right now. I don't think that their robots are going to be special compared to everybody else's robots. I don't think their robo taxis are going to be special to anybody else's taxis. So you start taking a look and say, okay, what are the Elon Musk fatigue stocks? And I got 4 of them for you. And I'm going to put these into an article, but I'm going to tell you here today. So the first one is Rocket Lab. I think you're going to see a lot of countries start to use satellite systems, which Rocket Lab just came out with one to compete with Starlink, and launch facilities and launch capabilities that aren't SpaceX. So I think that Rocket Lab is probably best positioned to close the gap between the pack and SpaceX. I think Blue Origin maybe gets there, but I just think that a company out of New Zealand, which Rocket Labs is, even though they're listed in the U.S., they started in New Zealand, very international company. I think that they probably are the ones that close the gap. When you take a look at the valuation of SpaceX being 250 to 350 billion, I forget what their last funding round was. You take a look at Rocket Lab and say they pretty easily could be, a serious challenger to SpaceX in the next 5 years. So let's suppose that SpaceX is overvalued by double, and it's really only $100 to $200 billion company. Well, these guys are way cheaper than that. So if they end up being a $50 to $100 billion company market cap wise, take a look at where they are now. And remember, that would put them on the S&P 500. So they'd get a floor underneath their share price as well. So as the S&P 500 magnet pulls them up, blasts them through 30 billion, where does the momentum end? 40, 50, 60, 70 billion, hard to know. Has to do with business execution, has to do with the macro economy, has to do with momentum. But Rocket Lab, I think, is cheap right now. I think that you should be taking advantage of this sell-off. I think that you can buy the stock, and I think that you can sell cash secured puts. So if you take a look at the June $20 puts, these are in the money, right? These are in the money. So $2.67, 57 cents in the money, but you can get $4.90 in premium. So that means that your net price is $15.10 if it gets assigned to you, and you're kind of setting this up to get assigned to you, right? You're hoping that actually it's still under 20 come June. I don't think that it will be. And that's why I think you need to take a position as well incrementally. Maybe you set some limit orders so that you have this cash secured put that gets you in at 15.10. Set the price at 5 and use the volatility to get 5. Okay. But I would also be scaling in now, right now. Or as they say in Super Troopers, right meow. Okay. Start buying this stock right meow. And if you're not, well, then I don't know what you do. Now, if you already own the stock, then I think only sell the cash secured puts. But I do think the June $20 cash secured puts are the way to go. What are some other stocks? You got AST Space Mobile, also as a Starlink alternative. And I think that it is starting to become very apparent to a lot of people that these guys are going to be a 50 to $100 billion company as well. So, they're getting some of the meme-alicious action from the millennials. You want to buy the dips on this one too. Now, it's hovering around 30. I have some covered calls at 30 and 40 that I'm trying to close. So I'm looking for a correction here. And my first batch of covered calls is for next Friday. So I'm trying to close those basically just net neutral. I just don't want to lose the stock. It is a large position for me. I have sold some May 25s and some May 30s. So the May 25s, which I think is where most of you should be going, you're getting 352. Right? I mean, that's a pretty good price. 350 gives you a net price of 2150. So I would take a look at those. Another anti-Elon Musk stock is Ford. Ford is moving up. So, I need to figure out a way to get in there. So sometime soon, I'm going to try to get in there. They don't have very good option premium, so I think you just buy the stock. And I sold around 11 and 12, so I need to get in before 11 and 12, right? Don't wait for perfect pricing. Just at some point, you just start scaling in, and hopefully, you get a dip. And then my last Elon Musk fatigue stock is Google. I think Alphabet is in a great spot to do a lot of things, and they're getting beat up right now because of the whole tech wreck that's going on. But when you take a look at Alphabet, you start to say, okay, search. What's going to happen with search? Well, search is going to be incorporated with their AI, and you're going to have a lot of people just by inertia continue to use it, and it's going to continue to improve, and they're going to slice and dice it the way Perplexity has, and it's going to be very, very competitive. So while Perplexity is great for doing research, Google is going to have a setting that does the same thing. I mean, to think that Alphabet and Google are not going to just say, okay, this is what's working and we're going to do it with ours is silly. It's silly. Now, here's where it becomes a Musk fatigue stock. Waymo. I am telling you that Waymo is going to be way more popular than Tesla Taxi or whatever they end up calling it, Robo Taxi. It's just going to be. Why? Because Waymo's ready right now. And I've used it in San Francisco, and it's just opening up in either Austin or Dallas. Is it in Dallas or Austin starting like now? Somebody wants to remind me. I think it's Dallas. But it'll be funny if they stick it in Austin right in his face, right? The geo-fenced urban use for Waymo is off the charts effective because they use the geofencing as well as the cameras and everything else to basically have these cars. Is it in Austin? Oh, that's funny. The Waymo is a great thing. And the big question is how many Uber drivers and taxi drivers get put out of business. And remember, Uber is going to automatic or robo driving too, and so is Lyft. Right? Lyft just cut a deal with Mobileye. One of the reasons to buy Intel is to get the Mobileye shares because Intel owns most of Mobileye. So you start taking a look at this and go, oh, there's going to be 4 or 5 companies in robotaxi. Yeah, maybe 6 or 7 or 8. These deals are in their infancy. The idea that Tesla is somehow going to dominate that market is just nonsense. I was thinking of I had a different word in my head. It started with Z, or actually it was a phrase that started with Z. And, I think that Alphabet also has a lot of moves that they can make with YouTube and some of their other companies, their broadband and everything else. So I think that Alphabet is one of the three mega caps that I want to own on a correction. The others being Amazon and Microsoft. What do all three of those have in common? Look up the cloud, right? They dominate the cloud. So those are the three companies that the internet, which is the backbone of the economy now, really can't do without. And you have other players that are edging in their Oracle a little bit, but really it's those three. So those are my Elon Musk fatigue stocks. And let's finish off with how the short is going. So I have those S&P 500 puts that I rolled to April and May. Actually, I bought April, and the March ones were about even, so I put them out to May. And I am going to sell 1/4, maybe 1/3. We'll see. I'm going to monitor the momentum, and I'm going to sell either 1/4 of my puts when they've quadrupled, so that what's left is a free roll. And if it doesn't look like it's going to quadruple, right? If I'm not going to get, I need about $19 or $20 on those April puts. Yeah, I don't really have a way to show you very well. Those April puts, if I'm end up being up 400%, if it looks like I'm going to get to 400% on the upside on those puts, then I'll sell 1/4 of them and free roll the rest, just in case we have an elevator drop. Same thing, if I don't think it's going to, on this first wave of down that you're looking at, I'll sell only 1/3 if I think it's only going to triple on the first wave down. And then when we get a rebound pop, then I'll buy another batch maybe in May. I do think that the likelihood of a Fed rate cut increases after this next meeting. However, this meeting on the 18th and 19th, the odds of a rate cut are 97% against. So nobody sees a rate cut coming. There's no reason for the Fed to do it because the market's already like discounting it to nothing. I think that the discounting, I think it jumps all the way up to like 50-50 for the following meeting. And we will see if I'm right about that. Something to keep in mind here is that even though tariffs are intermediate term inflationary, in the short term, they're deflationary. Why? Because they're killing the economy. It's just that simple. I mean, when you kill trade and create a trade war, there's a short-term pain. So you have to think of it as something that moves. And they need to get that 10-year treasury down. They have said that's their number one goal. Cause a light, shallow, short recession, and you'll get those 10-year treasuries down. You can bounce out all this debt that we have this year, next year, out 10 years, right? 5 and 10 and 20 years maybe, and you don't have to deal with it again for a long time. So they can really kick this can down the road by having a little short, shallow recession now, which will crush the stock market. And then again, next year you have rate cuts with a new Fed chairman or this Fed chairman. You have the end of quantitative tightening, maybe a special facility, don't call it QE. You have deregulation. You have private credit that's going mental. And I warn you that at some point, private credit is going to get destroyed. And I don't know if it has a little bit of a sock in the gut now and then a big, stepping on down the road. But the private credit markets, look, I'm just telling you, these guys are not the most scrupulous people in the world, and you're going to have problems. There's just going to be problems. So while I know some private credit people who do it the right way, I also know that there is private credit people who don't. And it's just a setup, right? I mean, they don't care. They just want to get rich today, and then they run and hide. And that's not dissimilar to what happened prior to the financial crisis. So I think that what we do get this year, a short, shallow recession, or at least the threat of recession, right? The recession scare. And then I think the next 3 years are pretty darn good. And then we'll see what happens after that. Now, Jamie Dimon has said that the debt crisis comes sooner. And he's probably right if they don't actually make any headway on the debt, right? So if suddenly all the talk is cut the debt, Doge, and then suddenly they piss away all the savings, and the federal debt goes up a record percentage again under Trump, which is clearly a risk, given the way things have started and what they're promising for tax cuts. Then maybe in 2028 everything falls off a cliff, right? And not 29 or 30 or 31, when the last baby boomers are in the system. A couple of things to keep in mind. They talk about this external revenue service. Look, if your bullshit detector doesn't go off full blast, sirens spinning and blaring and red lights and alien antennas, then I just don't know. You need some bullshit detector training, because there is not enough imports. There's just not enough imports to really dramatically reduce income taxes, and by doing tariffs. And in fact, I saw a statistic that said, based on the amount of imports, which will probably go down, right? That's why they're doing this. You would have to have a tariff of well over 100% to get rid of income taxes. So how would you all feel about everything that you import doubling in price? And then take a look around your house and what you wear in particular and what you eat. Would you be willing to pay double for everything to get rid of your income tax? Now, in this particular group, if you're purely self-motivated and you didn't take a look at the knock-on, you might say, well, maybe me. I know actually I would be good for me financially in a vacuum, but not if it destroys the economy. And that is one thing that Musk said recently. He said, look, we're not trying to destroy the American economy, because if we destroy the American economy, then everybody gets crushed, the rich included. And he's right about that. So when Shooter's AI and, scrapes the data and comes up with, hey, they're probably going to get rid of a lot of the tariffs at some point, I think that's right. I don't know how fast, because I don't know how much they can get other countries to acquiesce. Now, I will say this. I think that a lot of countries will cut some of their tariffs. And the reality is that other countries, almost as a rule, have had higher tariffs than the United States. So this is us saying cut it out. So that part of what's going on, understand that part. It's not just Trump being a punk, and he's good at being a punk. I mean, there's no doubt about it. That's a 1980s word for those of you not recognizing it. He's picking a fight that maybe should have been picked 20 years ago. So we'll see how it works out. But during this transition, which is a word that President Trump used over the weekend, right? President Trump used my word, right? How often have I said a transition is painful, right? Because it scares people and it changes things, and people aren't good with change, right? So understand that this is going to play out probably over most of this year, and that things probably get dramatically better next year at some point. Time frames are fudgeable quarter to quarter. Don't try to be perfect. Know where you should be scaling in and where you should be scaling out. And the last word is this. Some of the stocks that did the best in the last cycle will do very, very well in the next cycle. In general, don't try to find losers that you'll think will become winners. Find winners that are beaten down that will just go back to winning. That is the number one lesson of investing. The whole turnarounds rarely turn is so true. So while we want to find value, we want to find value in growth. So we want to find the fastest growing stocks with the fastest growing margins and the fastest growing earnings that happen to be cheap or cheaper because the whole market is getting its butt kicked. I hope that makes sense. All the empirical evidence supports that. Stop saying I'm a value picker and then picking crap. You get value by buying good stuff cheap. Not saying, hey, look, a piece of shit, I'm going to pick it up. All right. Any particular questions? Don't ask. Meta's earnings are this week. Wait for that. I caught somebody with their hand on the keyboard with that. All right. I really like those Musk fatigue stocks. I think that Rocket Lab and AST Space One will both end up between 50 and 100 billion by the decade end. I think that Google is probably a really good one to scale into. I will put out what I think that the scaling in prices are, because I'm going to do a whole article on the Musk fatigue stocks. I'm going to give it to you, and then a week later, I'm going to give it to, or 2 weeks later, I'll give it to Seeking Alpha Premium. So you'll have a couple of weeks to get a jump on the other 100,000 people who will read the article. All right. Have a good day. If the weather's good by you, go out and enjoy it a little bit, right? There's no point staring at a screen. It's bad for your eyes. All right. Have a good day.